All right, happy Friday, options expiration Friday. I have a lot of stuff rolling off that's unprofitable today, so it makes me cranky. I'm looking at this market. It's up today, surprisingly, but I gotta tell you, the sentiment and just the skittishness of the market is just unprecedented. It really is. Take a look at. So I went over this. This was the percentage of companies in the bullish point and figure formation. That's down to 11.6. Only 11.6% of the companies in the S&P 500 now have a bullish P&F point and figure pattern. That's really low. Underneath it here, look, take a look at this. 1.6% of the companies in the S&P 500 are trading above their 50-day moving average. It's like the entire index is just below its 50-day. 12.2% of the companies in the S&P 500 are trading above their 200-day moving average. These are extreme levels. Here's the new high, new low. Everything is making new lows. We're at minus 40 on that ratio. That's another extreme level. Take a look. This is a chart that compares the performance of the transports, the Dow Jones transports, versus the Dow Jones utility. It was the old Dow theory, and basically this blue line here represents where it is now. And so you can see that transports are really, really underperforming in utilities. It's probably a flight to quality or flight to safety on the part of market participants. But it dropped below down. It's below this 20% line, and usually that corresponds with an economic recession. So we're here. Are we going to have a recession? Could be. Market's certainly trading like it. The same thing here with consumer discretionary sector versus staples. You can see that there's a mass exodus of consumer discretionary names into consumer staple names. So the year-over-year relative performance is down here. It's at minus 20, which usually corresponds with some type of recessionary event. Very interesting. I like to look at this. Here's the price of lumber versus the price of gold. And lumber has been a relative underperformance. So if you do a comparison to that, you look like this. We're down here. This usually indicates some type of economic turmoil on the horizon. So another case for a recession, I think. So this is the AAII Investor Sentiment Survey, and they go out and they poll their members and they ask, are you bullish looking forward? Are you bearish looking forward? Are you neutral on the market? And usually this is a pretty good contrarian indicator. Usually when everybody is saying that they're bearish and they want out of the market, is usually a good time to buy. And when people are overly bullish or just high optimism in the market, it's usually time to get out. So you can see here that the percent bullish is down below 20%. Usually indicates in the past that as a contrarian indicator, it's a good time to buy. On the flip side, look at the bearish number. Bearish number is all the way up almost at 60%. So 60% of those surveys say they're bearish on the market. As a contrarian indicator, you might want to be looking to buy. This is the actual ratio itself. So I do the bulls over the bear ratio, and you can see we're down here below this 0.5%. It's just indicating too bearish, and it's usually a buy. In fact, if I go back, longer term to the 90s, I don't think I've seen that ratio as low as it is now. And this typically bottoms out at really good buying opportunities. So you see right here, there's a good buying opportunity here, here. So we're all the way down here. So is this a buying opportunity? Maybe. Put call ratio is really high, indicating a nervous market, also a contrarian indicator. So yeah, some real negative sentiment entering the market, and I can't say I blame them. It seems like this thing is down every day. Today we gapped up, then we sold off, now we're kind of flat on the day. Don't know where we're going. Anyway, options expiration. I have some stuff coming off today. For the most part, I'm taking losses across the board today. A lot of these were long calls that just got obliterated, and they're going to expire worthless. So let's start with a few of them here. So this is PayPal. PayPal, I had this bear put vertical on for a while, and it's dropped down. It's gone from like 89 down to 71. So it's working in our favor. I ended up taking half off today for a profit. So here on May 25th, I had sold the July 15th $75 puts for $4.75. Then I went ahead and I bought the July 15th puts, $80 strike price for $7.06. I unwound half of that position today for about a 49% return. That's the only, I think that's the only profit I'm going to have today. So get ready for a bunch of losses. All right, Paychecks, PAYX. I had, this is going back to April 21st. I held these a long time. These are the calls. June 17th, expiring today. $140 strike price. I bought them for $5.10, and they are expiring today. Worthless. I lost 100%. Here's one right below it. This is Waste Connections, WCN. Also on the 21st of April. I went long these calls. These are the June 17th, $140 strike price. Picked them up for $5. Today, worthless. 100% loss on that. So this is AbbVie, and I did a call back spread on this, and I'm happy that I did. When I did it at the time, which is right around here, this dotted line, I was expecting, because it was in such a nice uptrend, and it came down, it tested its 50-day moving average, and then started moving higher. I saw the MACD curling higher, but then I was wrong. But I did a back spread with this, so I didn't just go long the calls here. I actually did the, I levered I hedged myself to the downside. All right, so with the AbbVie on the bull back spread, I had sold. Listen, I bought the June 17th $160 calls, and I paid $4.42 for them. But then I went ahead and I wrote calls, $150 strike price for $9.87. So I had a little bit of a credit in there, were to fall below my level of profitability. So while I didn't make anything on the upside, it is below my level of my profitability level. So I get to keep the spread there. It's small. It's an 11% return. But all things considered, if I just would have went long the calls here, I would have lost everything. So I'm thinking maybe, especially now in this market the way it is, these bullish back spreads might be the way to go instead of just buying these calls, because I am definitely getting hammered going long calls in this market. Bull call vertical on FMC. I sold, I'm going back here, this is April 28th, and I sold the June 17th 145 for 570. I went ahead, I bought the June 17th 135 calls for 936. And I'm down. They're expiring worthless today, so I lost 100% of my money here. I had this straddle on XEL, and I went ahead. This was on May 3rd, so I bought the June 17th $70 puts for $1.28, and I bought the June 17th call, $70 strike price for $4.14. I unwound it today. I took a marginal loss on it, so it's about 9% loss, better than losing 100%, but. Yeah, so it's just another loss that gets tacked on today. This is LKQ, and I went long calls here. You can see this thing broke through its 20, its 50 real nice, and then the 20 rose above the 50. So I was thinking, okay, maybe this trend has changed. Came down, hit the 50 and held, came down, hit the 50 and held. I ended up buying it on the way up. I was doing okay in it. At several points during this trade I was profitable, but just couldn't hold on, and it just tanked. So today I'm going to be taking 100% loss on this. So the LKQ on May 13th, I bought the June 17th $50 strike price puts for $2.68, and they're expiring worthless today. Sherwin-Williams, this is a very similar chart pattern to what I saw with LKQ, right? This thing's gapped up. The 20 crossed the 50 to the upside. They seem to be holding support. I was anticipating that this thing would kind of trek higher, and now it just from 280 down to about 220 over the past week or so. So here we are, Sherwin-Williams, SHW. I had this is going back to May 13th. I had bought the June 17th calls, $270 strike price for $12.50, and I'm basically losing it all today because those options are expiring worthless. Here's Tapestry. I went long puts here, right? So this thing was following its trend line down. The 20 was below the 50-day. It came up here. It started testing this 50-day, and I was anticipating this was going to roll over, so I went long the puts. Now, it did break through for a while, and it did come down, but not far enough. So here's Tapestry. I'm long the puts. These are I did this on May 20th. These are the June 17th puts. $30 strike price. Paid $1.21 for them, and they're expiring worthless. I mean, this is like the past 2 weeks has been the biggest rout this market has seen in a long time, and I'm the one asshole here taking a loss on long puts. How'd that happen? Here's Boot Barn. You know, I did this off of an unusual option activity. You know, it's that unusual. I was experimenting with that for a while. It seems to be hit or miss. I think the way it's got to work is I got to look for extreme levels of volume in the options on the more shorter dated expiration, kind of signifying that there's something going on in the very near term. So a lot of these I was going out to like August and what have you, and it's really been hit or miss. So here's one that missed totally. So Boot Barn, I was long calls here. Normally I wouldn't have done the trade, but like I said, I was experimenting with that option activity stuff. So yeah, I'm gonna lose the money here. Here's Boot, May 31st. Went long the calls. These are the June 17th calls. $80 strike price. $5.39 is what I paid, and they're at zero. This is Williams Companies. Oh my goodness! Look at that. That is disgusting. I'm long calls here. You can see my reasoning, right? So when I'm looking at the chart, it was the 20 was above the 50. It was bouncing off its 20 in a solid uptrend. Even when the market was shaky, this thing just continued higher. I ended picking up some at the end of May, which is right around here. Probably could have waited a little bit and timed this better. But, yeah. With 37 down to 29 in like a flash. This is like a week and a half. It's disgusting. On May 31st, I went long the calls here. These are the June 17th, 39 strike price. I paid 25 cents for them. And I lost 25 cents. They're worthless. I lost all my money. All right, here's Bloom Energy. I went long the calls here. It just didn't quite make it. I kind of like this breakout. It came down. I thought I might have tried to test these moving averages, but I was wrong. So I'm taking another loss today. This is my last loss for the day. Pretty ugly day for me. Taking a lot of losses, mostly on the call side. Kind of depressing, but we move on. Here's BE on May 31st. I went long the calls here. June 17th, $18 strike price. I bought them for $1.10. They're expiring worthless. So all in all, I booked a bunch of losses today on stuff that just didn't pan out, and also stuff that I just probably couldn't unwind in a reasonable time. So the good news is that even though my P&L was up, I think yesterday it was close to $130,000 or so for the month, I'm still up about $84,000 and change. So even with the impact of today's losses, I'm still in pretty good shape for the month. So until next time, have a happy weekend. It's an extended weekend. I think we're closed Monday, so I'll see you Tuesday. Thanks.